Solvency II. Okay, so without any further ado, Carlos.
Yeah. Okay. Bom dia, and I'm very happy that everybody's still here. So I think there's interest in the subject. I think this is fascinating. It's a bit difficult. Ronald said yesterday that this is one or well, he was quoting that this is like a major change in the insurance industry, the most dramatic change in many years, and then you will see that everything comes naturally. It's just that there are too much technicalities, and then many things are not even well defined in the standard, right? So we have to many things are open to interpretation. So what would be the level of I don't know, how do you feel today? Do you feel better? Do you feel, what's the level of satisfaction about what you have seen yesterday? Are you, are you okay? Yeah. And level of understanding, more or less, yeah. Any open questions from yesterday? Okay, so here's the plan for today. We are going to see the reversal of losses for groups of contracts that are onerous. So this is when a contract is onerous or a group of contracts is onerous, and then it becomes again profitable. Okay, so a contract may start its life as profitable, then it can become onerous, in which case you recognize everything immediately, the loss immediately, but then the contract may become again profitable. So we're going to see how we reverse losses. Okay, so we should have, we need la presentación 2. Yeah, la 2. Presentación. Yeah, this one, yeah. And I'm going to flip these very fast, so we have seen all this, right? And we are, okay. Okay, so I want to start here, right? So remember that yesterday we were looking at these patterns. This was one of the nice, we spent much time here. Then this is called reversal of losses in an onerous group of contracts, okay? So the contracts were onerous, and then again they are profitable, okay? So how do we treat this situation? And in order to explain this, I like looking at numbers. You know, to me, perhaps I'm an actuary, I don't know. I think that makes more sense to look at the numbers. If I can do the mathematics, then I understand how how everything works. So in this case, we have 3-year contracts, okay? Also single premium, and we have 100 contracts, okay? Identical, and here we have the cash flows, all right? So we have 800 as premium, and then we have 3 equal outflows of 400. Now again, these 400, I'm not telling you how they were arrived at. I only indicate that these are probability weighted outflows. And then, well, then we see that the outflows are in total 1,200, right, which is larger than 800. So this is an onerous contract. Okay, there's a risk adjustment of 240. Okay. Which we're going to recognize uniformly in 3 years, which is the coverage period. Okay, so that's easy. Now, exercise for you. And it's too early to have an exercise, but anyway, calculate the fulfillment cash flows and the insurance contract liability on initial recognition at the end of each coverage year. Okay, so do you think you can do that? What do we need to do? Well, first we need to calculate the cash flows, right? The present value of the cash flows, right? So this would be the first thing to do, which I have this here. Okay, so everybody should understand this table. Yeah. no problem, okay? So again, we have the 1,000 inflows and then the 1,200 in outflows with the discount rate and all the rest, okay? So, and here is, basically this is just an example, okay? Now the second is that once I have, okay, so this is the process. Once I have the definition of the product and once I have calculated the probability weighted cash flows, all right, then I calculate the present value of the cash flows. I need the present value because I want the fulfillment cash flows, okay? The other step of the process is the discount rate. Here they are giving me 5%, all right? But it's not as straightforward. I will have to look at the cash flows and then I will have to decide which discount rate is appropriate. So we have this table. If they give the discount rate and the cash flows, putting together this table is 1 minute task, all right? Then I put, look at this. This is kind of the same table, except that instead of being in columns, this is like in rows, okay? So I have the estimates of the present value of inflows, all right, on initial recognition, and then the present value of, the estimates of the present value of outflows, okay? So with these elements, I can already calculate the contractual service margin. And what is that? Well, the contractual service margin is the number that would make this 0. But then we have a problem. What's the problem? That the estimates of present value of outflows is larger than the premium, okay? So in that case, the contractual service margin is 0. Contractual service margin cannot be negative. So if I were to, and we have to be careful when we do this in Excel, because if this was a profitable contract, I'm going to put a formula in Excel here that says that I need a number such that I get a 0 here, okay? So it wouldn't work in this case. So I need to put a condition that if this number, if the sum of these plus that is positive, then contractual service margin is equal to 0, no contractual service margin. That means no profit, okay, which is logical, it's natural, no profit, okay? So I have a initial contract asset or liability. Is it an asset or is it a liability? If it was an asset, it would have been negative because it's positive, then it's a liability on initial recognition, okay? So everybody can do this table as well. The last two tables, everybody can do them, right? No problem. Now, exercise 4, prepare the following reconciliations at the end of the first year, okay, assuming that experience emerged as expected, okay? So we have to reconcile these 4 things, okay? Do you think we can do the reconciliations? Well, let's see, we have, I'm going back. I think it's very important to know what is the estimates of the present value of the cash flows, 289 on initial recognition. That's very important. I move forward. So the first is estimation of the present value of cash flows, the reconciliation. And as you see, I have left this blank for you to do it. Do you think you can do it? Let's see, the opening balance is 0, right? Is 0. That would be opening balance. Now, changes related to future service, which is new contracts. What do we put there? What do we put there? I go back, okay? So one of these numbers, one of these entries is the changes related to new service, or to future service, rather, because I have new contracts in the group. Okay, so the liability, and we are reconciling cash flows at this moment. We are reconciling cash flows. In other words, we start from a balance of 0, and then we have to get a balance that is something different than 0. So the first entry is 0. The second one would be what? Any ideas?
The net of the cash flow?
Eh?
The net of cash flow?
Yes, the net of the present value of cash flows, yes. Then inflows. what do I put there in inflows? 1,000, very good. Positive or negative? Positive, positive, yes. Why positive? Because here we're talking about cash flows, okay? Then insurance finance expenses, what do we put there? 5% of, exactly, of the above, right? And then changes related to current service. Anything there? Well, this is remember that this is cash flows. I'm going to show you now. And then outflows would be the claims, right? The claims of 400, I think they were. Okay, so let's fill the table. So we have the 289, which, as Francisco said, is the net cash flows, or the net present value of cash flows. I go back to the 289. So there, somewhere you see the 289, right? On initial recognition, okay? And then I go forward. Then we have 800, which is the premium, okay? And then I have 5% of the above, all right? So I do 289 plus 800, and then I multiply by 0.05, and that's 54. And then the outflows, okay? So I'm moving from zero, present value of cash flows, from 0 to 743. So at the end of the year, at the end of the first year, I have 743. So I have made the reconciliation already of the cash flows. Then they asked me to do the reconciliation of the risk margin as well, okay? So this is, well, this I did it already. Risk margin, I start 0. Then I know that the change related to future service, in this case, and only in this case, new contracts, because the group was, the group was, I don't know, empty, and then I have the contracts coming to this group, and then I put the 240, which is the risk margin. Should be straightforward. And then how I get to the end of the year? Well, part of this is recognized on year one, and what is, we said, remember that the problem says we recognize this linearly in 3 years, okay? And yeah, well, I guess this is kind of a simplification for illustration purposes, so 1/3 of that is 80. Now, Brandon over there asked a question yesterday, which was, remember the question he asked about the amortization pattern of the risk adjustment, whether it had to be consistent with the CSM? Remember that question? Yeah? Yeah, you made the question, right? Yeah, and I don't know, that's a good one. That's a very good question, I would say. I think what you would do is that you need at each reporting time to reevaluate your risk position, okay? And then basically, I would say to be consistent with the coverage units. But then we have another problem with coverage units, and that is the lack of guidance, right? Coverage units is Article 119, right? And 119 tells us that we need to for coverage units, we need basically to consider the service or the service that is being provided, right? And the expected service to be provided. That's all they give. So it's open to interpretation. Here again, I say I have 240. I have 3 years, so I recognize this linearly. All right, but this is not like this is not a rule. This is just an example, right? In real life, you will have to recognize that accordingly. And also bear in mind that all these examples assume that the contracts are identical. Okay, so and these are oversimplifications so that we understand how things work. But in real life, don't do this. You know, in the real life, you have to account for different coverage units and different amortization patterns and so on and so forth. What other reconciliation we have to make? Well, the contractual service margin starts at 0, okay? Starts at 0 and ends at 0. So this is not left blank. This is basically what happened in the year. Why? Because it's a loss, right? So if it is a loss, there's nothing recognized, and then the CSM never gained anything during the year, no interest, no nothing. So it's I don't know, in terms of reconciliation whether we present this table or not. You know, it seems to me that is absurd to present this table, but just to be on the safe side, we have a footnote. So we say that the entity does not recognize the contractual service margin in profit or loss because the contractual service margin is equal to 0, okay? So maybe the footnote is sufficient, I don't know. What other reconciliation we have to make, which is the last one? The liability, right? The insurance contract liability. And again, starts opening balance with 0. This I left blank for you to think about, okay? Then I will have new contracts, I will have inflows, and inflows are the same. We know the inflows, we know the outflows as well. We know how to calculate the insurance finance expenses. And what about the changes related to current service? Any ideas? Okay, let's look at them. Basically, remember that the 529 is what? 529 is the when we did the initial recognition, we had basically a liability of 529. I go back. So you see somewhere the 529 there in that table. So what is that? That is a liability at initial recognition, okay? So in my reconciliation, I start with 0. I start with 0, and then I add the new contracts to the group. Or if you want, you can put the 529 at as opening balance. I think it's best to do it this way, but and to say explicitly that this 529 is because the group started with nothing, and then these contracts came to the group, so you recognize the 529. Then we have inflows, that's easy, 800. Then we have insurance finance expenses, which is 5% of the above, right? Of the above, I mean of the whatever 529 plus 800 times 5%. Then we have changes related to current service, okay? To current service. All right. And then we have the outflows, and we close the liability to the liability was 529, and by virtue of having cash flows in the period and insurance finance expenses, because all these accounts are credited with interest, or accreted, they say accreted with interest in IFRS 17. So these accounts tend to grow, right? And until eventually they become 0. They start at 0. At the end of times, they will become 0 again. Okay? So these are the 4 reconciliations that we have to do. All right? Good. Exercise number 5. Now, prepare the analysis of the insurance contracts with, this time we are going to have an explicit identification of the so-called loss component, okay? So there's a loss component that we yeah, we need to identify separately. Okay, so here, basically I have the liability. Remember that liability is always liability for remaining coverage plus liability for incurred claims. But here I have an additional column that is called loss component. Okay, so so let's look at each of them separately. Remaining coverage. Okay, I put the inflows, I put the insurance revenue, and this 289 becomes insurance revenue, right? So this 289 was, if you remember from one of the slides, it was the difference in cash flows. Okay, so this becomes insurance revenue. I'm going back because it's worth looking at this 289. So I go back. Somewhere we have here 289. Okay, net cash flows. I move forward. Okay, and then we have insurance finance expenses, right? That should be easy, 5%. Okay, and then we have a loss component, and here we have a number that is not straightforward. Well, I'm in the second column, or technically the third column, in the loss component. So we have that insurance service expenses. I separate that into two pieces. One is the reversal of loss on onerous contracts, okay, and the other is incurred expenses, okay. So yeah, 529. We have seen that number, okay. 191. How do we calculate 191? Okay. Now this is an artificial allocation, all right? And they tell you they suggest how this allocation could be made. And what I have here is that I'm going to take in the. It's unfortunate that I don't have word to write, but let me. I'm going to take 1089, and 1089 is the estimates of the present value of outflows, okay? And I'm going to add the risk margin, or the risk adjustment, which is 240. I will have that in the denominator, and in the numerator, I will have, again, 529, okay? And basically, this is going to give me a number that when I multiply the 529 times, when I multiply, let me think. When I multiply, I think I'm going to do it in my phone. Mm-hmm. Okay, so I will have 191 divided by 189 plus 240. No, okay, okay, yeah. Divided by 529. No. $40. 529 divided. No. 9 plus 240 divided by 29. something. No. Yeah. What I have basically this 199. This is the difficult component. I basically allocate the proportion of the liability. So I divide the liability by the what I tell you, the present value of the outflows plus the risk margin. Present value of outflows 1,089. I go back. 1,089. So you see 1,089 here, plus what? Plus the risk margin. And this is the proportion that goes into the loss component. So it's basically a artificial allocation. And again, they don't tell you how to do it. They tell you that should be allocated to these incurred expenses, or this loss component should be allocated to incurred expenses, and then by the same token, I do the allocation of the 54. So I have in insurance finance expenses is 54. So this number is not 5% of these two, but rather is the allocation of the loss component of the insurance finance expenses using the same logic. And then again, the factor is 529 divided by 1,089, which is the present value of outflows, plus 240, which is the risk margin. Okay, so it's a bit tricky. I think I have an Excel sheet. Yeah, I'll perhaps I can share with you an Excel sheet where I did these calculations. Then we have incurred claims. Okay, that's straightforward. And then insurance liability is simply the sum of each line, right? And that's it. Okay. Now, what happens? So the contract was losing money, okay? It's clear that was losing money. So now, at the end of the second year, the entity recalculates the estimates of the present value of cash flows. And by the way, this recalculation, you don't have to do it at the end of the year. You will do it at each reporting period or at each period where you do your IFRS numbers. Now, if you want to do it every quarter, that's okay, even better, because you're up to date with your accounts. But anyway, how often you do the accounting, right? Well, you do the accounting on a continuous basis, right? So you can technically you can calculate. You can do the recalculation of the estimates of present value of cash flows every month. Why not? Okay, because anyway, the system should be able to do that for you. So you will have a system that does that automatically. So here I say that we are at the end of the year, and we have basically discovered that we do through a recalculation of cash flows that instead of 400, so I was expecting. Thank you. Instead of expecting 400, I actually have outflows of 100. So the risk adjustment, and then here the risk adjustment was not adjusted. Okay, perhaps I could have adjusted it, but perhaps not. Perhaps the actuary decided that just to be on the safe side, on the conservative side, even if this contract became or had a reversal of losses, I still keep the same risk adjustment. Now I would have to prepare the reconciliation of the second year, okay, and the analysis of the with explicit identification of the loss component. So here in this case, I have the first column we did already. Now the second, right? The second, we have a number that we cannot easily identify, which is the 285. But the way we do it is that we compare the cash flows. So we have again to do the cash flow calculation. Remember that yesterday we had some tables where we said this part is not relevant, something like that, because that was history, okay? So every time that there's new estimates of the cash flows, I do the recalculation, and then the changes to future service are basically the number that adjusts the cash flows. So this, believe me, this 285 comes with this process. I don't have the supporting table for that. And then insurance finance expenses is only 5%. Is also 5%. And then I have the second year. Notice, of course, that the closing balance of the first year is exactly the opening balance of the second year. Okay. But look at what happened to the cash flows. Used to be 743, and now they are down to 95. Okay. Now, the risk adjustment, right? Here, basically, I take away another third of the original risk adjustment because the problem said that there were no changes in the risk adjustment. And then here, changes related to future service. Contractual service margin used to be 0, right? Now it's 102. Now this is the change that allows for the contractual service margin to be something that is above 0. Okay, so I have a liability, and then this number allows me to have a profit. So this contract turned into a profit. Okay, so even though the contractual service margin was born at 0 and then ended the first year at 0, then in the second year, we have changes related to future service. That is basically, this is basically a derivation of the cash flows, of the new cash flows that I have that turn that into a profit. So I have a modest profit here. Okay, this 183 we saw first, second year, sorry. And then the rest is mechanics, 5% and cash flows, and that's it. Okay. So the insurance contract liability. Look at the change from one year to the next. It used to be 900, and now is 277. Okay. And that's simply because there was a substantial change because I was expecting to pay 400. But then I pay 100. So this is in this small contract that makes a lot of difference. Okay, and then here I have the numbers as well. The 191 is familiar. The 183, I go back. 183 is this number here. Changes related to future service. Yeah. Exactly. Yeah. No changes in the risk adjustment. Okay. And then I have the again the allocation of the insurance expenses between loss components and remaining coverage. Okay. It's like the remaining coverage. We extend that column, and instead of having one column, we have two columns, right? Because incurred claims is going to be the same. If there's a loss component or no loss component, it's going to be always the same. But then what changes is we split this. It's like we how to say, not collapse, but the opposite of what? Expand. We expand that column into two. So this column becomes two columns, right? And we have, we are required to do this disclosure. Okay. And then again, incurred claims, we know that. And then insurance liability is simply the sum of the rows. If we go by row, we have the insurance liability, which, if you look at it, it's a bit silly, right? So this 276 is the same as this 276 there, because these numbers, I was able to, with this 100 instead of 400, I was able to wipe out the loss component. I don't have loss any longer, right? And so everything works out to be the algebraic sum of this is 0, right? No. Yeah. So I think if you follow it in Excel, once you have, I recommend that all these tables, you do your Excel tables to understand. And of course, these Excel tables are just for illustration purposes. It's not that you are going to use this officially for your IFRS calculations. You need something a lot more powerful than Excel. But so that you understand how everything works, I recommend that you do your Excel tables, and it's not that difficult. If you have questions, just let me know. Now, okay, so that was reversal. Yes, you have a. Yeah. Yeah, a few questions.
I'm super clear that we are doing the exercise for illustrative purpose, and it's great because make it transparent. But I'm thinking, for in order to improve an initial situation in which we have an onerous contract, from a practical perspective, we will try to manage the claims ratio, right? What we talk. We name claims ratio, the potential level of sinistralidad, the claims over the policy,
loss
right?
Ratio, yeah.
I'm thinking, what will be the component on the exercise that will be affected? Seems that the one driver I have is the outflows, cash outflows, right?
Yes.
Because the discount is there, the insurance service expense should be in the same level, expense as well. So the component to manage in order to improve a situation is exclusively the claims level, right?
Everything is cash flow driven. Everything is cash flows.
Okay.
Well, not everything. It's like in order for us to reverse the losses, it was basically cash flows, and it was basically that we estimated that the future is going to be better than we had assumed. It's just an assumption. We
Sure. So in the exercise we have, for example, the 400 or 150 as each year cash outflow. But the second year, eventually, I think we did that exercise. We modified the cash flow.
Yes.
And this could be because the level of the claims, or we incorporate a new reinsurance contract, or other component, right?
Yeah.
The inflow, the cash inflow is something that is mostly premium, right?
In all these examples, I am doing a single premium. Okay.
Yeah.
But most typically, I will have annual premium, right? So the inflows also affect that. Now in life, normally we know what the level, or what the periodic premium or the level premium is going to be, right? So we know that, and there's we cannot expect that the premium is going to change or anything, right? The premium is fixed at contract inception. Yeah. So I would have to to also to put inflows.
So in summary, the leverage should be exclusively the cash flows.
Exactly.
The inflow and outflow.
But then remember also that we had one slide with all the things that are cash flows, right? So commissions, expenses, whatever, and then you have to estimate how much your expenses are going to be, and these are expenses that are connected to the business, right? To the block of policies.
And there is some exception to unlock the rate, the discount rate, or is no way?
It's locked. Yeah.
Okay. Thanks.
Good. Okay, so that was the reversal. Now, very briefly, yesterday we spoke about risk. Today, in the solvency part, we are going to or maybe tomorrow, speak about risk again. Which one has more risk here? That's another question. Which one has more risk? The left. The other is certainty, right? Okay. here, I presented this table, and I just wanted to, you know, I was very light explaining how I calculated these numbers, but I added another slide this morning so that we know exactly where these numbers come from, and which is the next slide. Okay, so we have here we have the expected benefit amount, and this is I go back. This is basically the multiplication of the number of insured people, sum insured, and QX. So that's expected benefits, and the sum of this column is 206. Okay, which is the 200. So this is the expected value of the claims, right? And then I have a standard deviation of the claims, right? I have calculated in the last slide a variance, okay? And then I take the sum, and then I take the square root, and that's the variance, okay? Now with these two things, I said yesterday, I can't remember how I calculated the pure premium, so I tried to replicate again until I got what I thought it was right. So in this particular example, pure premium is that premium that allows me to be profitable 95% of the time, right? Why 95% of the time? Is just because I say so. No, it's not. Yeah. And basically, what I did was that I used the 95th percentile of the aggregate distribution of claims. Now here, because I have 10,000 policies, I'm assuming that using the law of large numbers, that each policy is a random variable, and I have 10,000 random variables. The sum of random variables behaves like a normal distribution. So for the pure premium, I take the average, or the expected value, and then I add the 95th percentile to get this number, okay? So it's like, remember oh, here I have. Okay, so here I have 95% of the probability mass, okay? And this point here corresponds to 237, okay? This point here corresponds to 206, this is 237, so I'm here, right? So, and I say, well, the premium is going to be such that 95% of the time I'm profitable, right? And that's it. It's not that I don't know. I can do whatever I want with the calculation. Then the gross premium, I said, well, we have 25% in expenses are 25% of the gross premium, so I grossed up the pure premium to get the gross premium, 316, and then this is the value at risk. I said that it was the 99.5 percentile of the distribution. So notice that this formula is identical in form, like the pure premium, right? It's the same formula, right? Simply, I'm saying that my solvency requirement is going to be, I'm going to be solvent 99.5% of the time, which is the Solvency II standard. And then I do the shifting, all right? So the shifting is what is, you know, and that's the definition of risk. Risk is deviation from the unexpected. Expected is 206. Unexpected is in this case, the 99.5 percentile, which is like this here. So this distance is the solvency capital requirement, okay? If I'm under Solvency II. Now, in Switzerland, we use the T-bar, and this is a compact formula for the normal distribution, okay? And by the way, this is here I use 99%, not 99.5, but 99%. So I'm taking, the difference is that I'm taking the integral from the 95th percentile until 1. And where is 1? 1 is when the curve reaches infinity, right? So that's 1. So if I'm working in Switzerland, my capital requirement would be 50,897. If I'm working in Europe, right, is 49. It's a little bit lower. So in this respect, the Swiss standard is a little bit more conservative than the European standard. Okay, so these are, again, these slides you are going to get, and then you see the formulas. Now, again, I'm not saying that this is the only way to calculate risk. This is just one way of calculating risk. Then, this is number 2. Then I want to go to number 4, cuatro. I go to number 4. No, this is this, no, no, this is not, it's cuatro? Yeah, this one, yes. Okay, so, yeah. Okay, so, I think we have, we looked at this table. I was going to say what?
Was it Spanish yesterday?
It was Spanish yesterday, yes. Yeah. So this is besides actuarial, finance, and IT, all the you know, all the different functions, or just a catalog of functions. Some companies have more functions, some companies have less functions, whatever. I think that the important point here is that everything that is yellow or red has an impact. Everything that is green has less impact. For example, branding. I don't think my policyholders are going to care whether if there's little impact for them, you know, for in terms of IFRS 17. Of course, there's indirect impact that maybe some products I will have to modify or discontinue or do whatever because they may be I don't know, they may be not aligned with my new reporting standards or whatever, or maybe I was expecting more profit and IFRS defers profit recognition, so I changed the profit margins, and then the policyholder ends up paying more. I don't know, this kind of impacts, but then many of the functions are impacted, even HR, because HR is responsible for training, right? Or talent development, I think they call it in some companies. So HR needs to make sure that people are relatively knowledgeable, have a solid base, solid knowledge of IFRS 17 if they are going to work on that. Okay. Then we also had this chart yesterday in Spanish, but overnight my computer translated everything. While I was sleeping, the computer was doing a translation. Okay, so bookkeeping. Did you know that bookkeeping is the only word in English language with 2 O's, 2 K's, and 2 E? 2 O's, 2 K's, and 2 E's, right? The only word in English language with a repetition of 3 letters, yeah. Double O, double K, double E. Yeah? Bookkeeping. Yeah. And how do we say bookkeeping in Spanish? Registro, or what do we say? Or contabilidad? Contabilidad. Yeah. Okay. So these are okay. If the task is to calculate the contractual service margin, what we have done in these slides, who is doing what? Well, this is just an example. So we have to do the accounting or the bookkeeping, and then we have to update the CSM and the risk adjustment. So who's going to do that? Most likely is going to be the actuary is going to basically have a role in the contractual service margin. But I would think that here, if we are talking about bookkeeping, is the accountant, right, or the finance function who is going to do that. Then we have calculation of the loss component. Who does that? Well, to calculate the loss component, what we need? Well, we need cash flows, right? So we need the actuaries. but I think also the accountant should be involved. So this is, to me, this is a role that is, or a task that is shared between the actuary and the accountant. Then maintenance on the general ledger, accountant, IFRS reconciliations, what we have done now, and then reconciliations with other systems and methodologies, well, accountants and actuaries, because you have also your solvency standard in Brazil, and somehow you have to reconcile your risk margins under your solvency standard in Brazil and your risk adjustment under IFRS 17. Then preparation of notes to financial statements, I think actuaries and accountants, okay? And update of accounts to reflect the effect of exchange rates, probably accountants. Okay, so this is just a component, contractual service margin. But I think the idea of this slide is to let you know that there's got to be a full cooperation between actuaries and accountants. Okay, and like I said again yesterday, also IT, because we have systems to. So we need to be able. For the systems to communicate. So it's just one example here. Then I was talking about that Europe has this traditional or classical model where the finance function is there, the actuarial function is over there, and the risk management function in the next building, right? So, yeah, and this is of course, this doesn't happen everywhere, but traditionally, actuaries work in isolation, traditionally, in Europe, okay? And what do I mean by isolation? Well, they have their own systems, and then the actuarial systems are not integrated into the overall IT framework of the company, okay? So for example, there's a policy administration system that is not connected to the actuarial system. And some people will use software such as Prophet, Moses, Alpha, all these, well, you recognize these names. And these are not necessarily connected to the accounting system, right? Or the policy administration system. So here's a list of things that have motivated the so-called convergence of functions, including well, basically changes in the business environment that is volatile, that is uncertain, complex, and ambiguous, and yeah, many other things, right? Reduced operating margins, more merger and acquisition activity, changes in recruiting qualified staff. I don't know what would be the case here if you find good staff for insurance companies, but sometimes it's not very easy to find staff in many markets. In some markets there are in many markets there are no actuaries. We have of course in Latin America we have actuaries in or a traditional actuarial profession in Brazil, in Argentina, in Mexico. Yeah. Chile is a big market, but I wouldn't say that is a very traditional profession. So what other countries do? Well, what do they do in, well, Colombia, they have a few actuaries. But they're not, they're not very prevalent in many parts of the world. Actually, the number of people, the number of so-called qualified actuaries in the International Actuarial Association is about 75,000. And you remember how many actuaries are there in the Society of Actuaries? Ronald told us that yesterday. I think he said 31? 32,000, okay? 32,000 US, about 75,000, the whole world. So US is a big chunk, 40% of all actuaries in the world, okay? But the number of accountants in the City of London, in the UK, is about 150,000. Wow. So there's twice as many accountants in London than actuaries in the world. Yeah, yeah. Yeah, but accountancy is very, I think it's a very good profession because you have to do the accounting, you have to do your financial reporting according to what the accountants say. So it's a good profession, which reminds me, which one is the oldest profession in the world? Not the one you're thinking. No, not this one. Well, there was a convention one time to decide which was the oldest profession in the world. So basically the doctors say, well, medicine is the oldest profession in the world because you go to the Bible and then woman was created with a rib of a man, right? So it's the oldest profession in the world. The next day, the engineers come and say, well, if you look at the Bible, all right, in the beginning there was darkness, and then God created the mountains and the seas and the forests and the rivers, and this is engineering process. So engineering is the oldest profession in the world. Okay, the third day the actuaries came. Well, take again the Bible, and then you open and first book of Genesis, or first book of the Bible, the Genesis, it says, at the beginning there was chaos, and in order to have chaos, you need actuaries. So actuaries is the oldest profession in the world. Very well. We also had this table before, okay? My computer translated it, and basically it's a possible way to possible things that you have to do for implementation. So I have IT, I have corporate strategy and operations, and I have accounting, okay, and internal processes. And then one in the bottom that is called support, okay, supporting function. Now, what do we need? We need all these three functions need solid knowledge of IFRS 17. They need to know the company requirements. They need to know the target operational model, do a gap analysis. Gap analysis is what do we have and what we don't have, and then try to work out a solution, etc. Assessment of operational impact, so on and so forth. We have to prepare budgets, etc. And then the boxes on the right-hand side are typical for each function. For example, IT, well, they need to assess the situation of the systems, business implementation, migration, etc. Corporate strategy, well, they deal with products and portfolio, etc. And then accounting, well, the accounting framework, the training, process redesign, and re-expression and comparability. And then the supporting function is a function that is going to basically provide support to all these functions above. Now, this is not universal, it's just an idea of the things that have to be carried out for an implementation of IFRS 17. And then we will, later we will talk about software and engines and things like that. Okay. Right. Any questions here? Okay.
Can I go back one?
Yes?
What do you mean by re-expression and
re-expression? Yeah, that re-expression means that basically the accounting has to be re-expressed under the new standard. Yeah. Yeah. And comparability means how what's different between 17 and 4. Okay, so we now switch to number. Is this number 5? This is. It's in order. It's in order. Yeah. Okay. This is 5. Okay. So this is called measurement of direct participation contracts. And again, all the slides have this disclosure. You don't have to read it, but you have to make sure that you understand that you cannot take legal action against the Society of Actuaries. Okay? Or Ronald. Okay, so So this is what we have for today. So we were doing sort of recap of yesterday and looking at the reversal of losses. For today, we look at direct participation contracts, then the so-called premium allocation approach, which is a simplification. Then we look at the presentation of results. Then we look at data management and calculation engines. And that's, the first 4 points are IFRS 17 points. Then point 5 and 6 are Solvency II. So we start with Solvency II, with the background, scope of the directive, of the European directive, the quantitative aspects. We start today if we have time, but we continue tomorrow with a lot of quantitative elements. And then governance tomorrow, and risk management and reporting also it's going to be tomorrow. And by the way, this for the lunch break, we will finish 10 minutes earlier, just because I have to. Apologies, I need to make a phone call. So we start. We recuperate time later on. Okay, so what are direct participation contracts? In essence, these are contracts that have a savings sort of a savings component. Here, what I say is that we have unit-linked products or hybrid products as examples of direct participation contracts. So, definition: insurance contracts that include features that share returns on underlying items. This is the word used in IFRS 17. So underlying items could be an index, all right? Could be a pool of assets, whatever. So these underlying items are certain reference index or reference assets, and then the policyholders are going to get certain participation in the increase of these underlying items, okay? So there are some investment-related services included in the contract. And IFRS 17 says, oh, okay, wait a minute. If you're going to provide investment services, then this has a different treatment, because what we have seen thus far is the insurance service, but not the finance service, all right? So an insurance contract is considered to be a direct participant contract when the policyholder participates in a share of pool of underlying items. The entity expects a substantial portion of any changes in the amounts to be paid to the policyholder to vary with the changes in the fair value of the underlying items. So if this doesn't happen, then the contract could be either indirect participation or could be a non-participating contract. So that's basically the idea, right? Now, we have here 3 headings for non-participating, indirect participating contract, and direct participation contracts. Okay, for the first 2 cases, we use the general measurement model. For the third case, we use the so-called variable fee approach. Okay, now this is regarding measurement, regarding changes in cash flows due to financial risks and time value of money. Well, under general measurement, we know that there's immediate recognition in the income statement. We know that already. But for the variable fee, we consider the part of variation in fees that is recognized that part is recognized in the contractual service margin. And then the interest credited or accreted to the contractual service margin, well, this is locked in, or I think we put here interest rate fixed at initial recognition. But then for participating contracts, there's no such concept, right? No explicit interest accretion, given that the CSM is recalculated when financial risks change, okay? Now, when you do the contract classification, you cannot say, this contract used to be participating and now is non-participating. This cannot happen, right? So you basically do the classification at contract inception, and then it is prohibited to reclassify later. Okay, so this is a scheme of the variable fee approach. So I'd like to say that the variable fee approach is similar in many respects to the general model, but it has some difference. In the general model, we talk about CSM. Here, we also talk about CSM. Okay. Now, the thing is that you split the obligation to policyholder into two pieces. One piece is the obligation to pay they say the fair value of underlying items. Okay. And then again, underlying items could be a pool of assets, could be an index, could be anything. And this has immediate recognition. And then the variable fee charged by the entity, this is deducted, all right? And we adjust the contractual service margin for that, okay? So, in other words, the insurance company becomes a provider of financial services. And if you're a provider of financial services, then you are not providing insurance service. So, okay, you are providing insurance service, but also you are providing some financial service, okay? And we're going to, again, my favorite method to understand what goes on is through a numerical example. So let's do that. Just as a reminder, we have our typical friend, contractual service margin. We know this already, but there's something new that is here in this slide in orange. This orange box is the entity's share of the change in the pool of assets, okay? So if the pool of assets changes or the index change, then there's an entity share, okay? And there's also a policyholder share. So this is the only change. This new box is highlighted, okay? The rest we know. Okay, we haven't, in our examples, we haven't dealt with effect of currency exchange, effect of currency exchange, but the rest we have dealt with. Okay, so here's the example. So an entity issues 100 policies. Okay, so there's a single premium of 150 per contract. Okay. So the coverage period is 3 years, and then the death benefit is the largest of two things, 170 or the account balance of the policyholder, whichever is larger, okay? So it may be that the account balance, okay, if I talk about account balances, I mean that these are individual account balances. So each policyholder, we open an account for each policyholder, and then this account is earning interest or is being credited with interest, and then if the person dies, he gets whatever he or she gets, or not he or she. His or her beneficiaries get the largest of 170 or the account balance. That's clear. Now, for that, the insurance company charges 2%. So this is called a fee, contract fee, or something like that. Contract fee, 2% of the account balance charged at the end of the year. So this is another source of revenue for the company. 2% of the account balance, okay? Why? Because I'm managing the assets on behalf of the policyholders, and I'm also doing the administration and bookkeeping of the individual account, etc. So let's work with the following assumptions. There's a 10% increase in the underlying items. So the underlying items is the accounts, right? There's a discount rate, in this case 8%. The risk adjustment is 25, and we are going to recognize, in this case, just to have a different thing. I didn't put linear. I put 12, 8, and 5, the sum of which is 25, at the end of years 1, 2, and 3, respectively. And then I'm going to assume that one policyholder dies each year, which is a rather high mortality rate because I have only 100 individuals, so it's a in the first year, I'm assuming a mortality rate of 1%, okay? Rather high, okay? But anyway, it's okay.
What's the risk adjustment? Is it like what? Is it like selection or something? What's risk adjustment?
The risk adjustment is the consideration that you need to take this. You calculate that with the mortality. There's a mortality element there, and that's a yeah. Okay. So having said that, basically I have my estimates. Remember that it was 150, but we have 100 contracts, so the premium is 15,000. Then the rest is I don't have a disclosure how I calculated these numbers because here not only do I need to do whichever is greater between the account balance and the death benefit of 170, but also there's a guarantee, right? Un derivativo embutido, ¿no? ¿Cómo se dice? Derivativo embutido of this guarantee. This has a price, okay? How I calculate this price? This is a subject of a different course, right? Well, basically, I have to. I can do it with option pricing theory, okay? So it's like a financial engineering. I need to calculate what is the value, the commercial value of this guarantee, okay? This, the fact that I can always win. I cannot lose. So I have upside potential. And I have, as a policyholder, I have always upside potential because if my balance is greater, I have a larger benefit, and I have downward protection. What is downward protection? Never will I receive less than 170. So this costs money, okay? So with option pricing theory, we can calculate the present value of the cash flows, or of the outflows, okay? So here we put actual estimates. Here you need an actuary. There's no way around it. An actuary, by all means, okay, to do these actual estimates, including the cost of the embedded guarantee, guarantee, what we call derivativo embutido. Then we have the risk adjustment for non-financial risk, and my table again. What do I need if I have minus 795? What do I need to turn this number into 0? I need 795, which is the contractual service margin. Okay, everything clear, right? So here we are not applying any. This is a general method, right? Here this is identical to the general method. Okay. Now, this is the fair value of the underlying items. So with these accounts, with these with these deposits, this is how the things progress from one year to the next. Okay, opening balance 0. Then I receive 15,000 in premium. Okay, that's clear. Then change in fair value is 10%. Okay, so this 15,000 go into a pool of assets, and then this pool of assets earns 10%, so that's 1,500. Then I have to charge 2%, right? So this charge is basically 2% of the above. And then I have to pay death benefits, and then I assume that one individual dies, okay? So how do I calculate 162? Well, 162 is 15,000 plus interest, or the plus increase, whatever, minus fee, divided by 100, and this is what I paid a single policyholder, 162, right? Now, didn't I say that the minimum payment is 170? Yes, it is, but for now we put here 162. We are going to account the other 8 differently, okay? Now, I get 16,008, which is the opening balance of the next year. And then same mechanics, no premium. Change in fair value is in this case 8%, here the problem says 8% of that number, then I have the contract fee, which is this plus that, times 0.02, which is the 2% of the account balance, and then I divide that by 99, exactly, 99, because there are 99 survivors. So the person dying would get 171, which luckily is higher than 170. Okay. And then the next year, no premium, change in fair value, 10% of the above, then contract fee, and then everybody gets their account balances back. Okay, so here I will have the amounts assigned to each debt plus the account balances paid at the end of the coverage period. So this is easy, no problem. Now here's the changes in insurance liability. And then I have some notes here. I have an opening balance of 820. Yeah, what is 820? 820. Well, let's go back. We have the difference between 15,000 and 14,180. So the difference between these two is the 820 here. Then I have premiums, the benefits paid. Now here I put 170. Okay, it's 170 really, because I had, this is in cash flows, I had to pay 170. I put in the other table I put 162, but remember that there was a minimum guarantee of 170, so I put 170 there. And then I have something called the entity's share in underlying items. Okay, so that's 1,500. This is the increase in the accounts multiplied by 2%. So this is the fee that the company receives. Then I have something called effect of time value of money and financial risks. And this is a bit tricky to calculate. What I do is that I take the difference between the increase in the underlying items, which is 1,500, and then the fulfillment cash flows, which is 1,403. Okay, the difference being 97. Okay. But I know that 30 are allocated to the entity. Therefore, the balance should be the time value of money and financial risks. So I calculate that as a balancing item. Okay, and then just let's clarify these two numbers, 1,500 and 1,403. Yeah. Okay, so the 1,403 should be the difference between, thing is between these two, and then the 1,500. I'll check that. And then the 1,500 is the 1,500. Where is it? The change in fair value here. Okay. Then the risk adjustment, we know that it was 25. First year, I think we recognized 12. And that's it. Then contractual service margin, 795. Then I have, the change in underlying items, this is the same. And then I have 300 of recognition. Now, this 300 recognition is basically an allocation, all right? So I have, and here this is good for those interested in the subject of coverage units or units of coverage. You see at the bottom, we are providing 100 units of coverage. 100 units of coverage in year one, but we expect one death each year, okay? So the total coverage provided is 100 plus 99 plus 98, but this year we provided 33.7% of all the coverage, okay? So this is a case in the, we are used to say units of coverage are the same for everybody or for every year, but here in this case, this is how it is actually done. We have to take into consideration the deaths, okay? And still, the size of the contracts is the same, okay? So we multiplied 892 times this percentage, and then we get 300. And what is 892? Is simply the 792, okay, plus 30 plus 67. What's 30 and 67? Or I can say it's 97. Whatever is the difference between cash flows, the increase in value and the fulfillment cash flows, and that's it. Okay, so this is how basically the variable fee approach works, and we haven't finished the story. I'm going to stop here for the coffee break. When we come back, we finish this story with the variable fee approach. Okay, all right. So enjoy the coffee, and we meet at 11.